Welcome to CFA Level 1. Today we're discussing the efficient market hypothesis, theory, reality, and AI impact.
Hey everyone, and welcome to The Explainer. Today we're cracking the code on literally the ultimate finance mystery, the efficient market hypothesis. It's a concept that sits at the very heart of modern finance and trading, and honestly, it might just change the entire way you look at the stock market. So here's our roadmap for today. We're going to cover, can you beat the market? The 3 levels of market efficiency, a reality check featuring Apple and GameStop, calculating your abnormal return, how AI changes everything, and finally, test your market knowledge. All right, let's jump straight into Section 1. Can you beat the market? The efficient market hypothesis. I want you to really stop and think about this for a second. Can you actually consistently outsmart Wall Street? Or are the cards fundamentally stacked against you? It's literally the multi-trillion-dollar question, right? Every single day, millions of traders are out there staring at charts, reading reports, desperately trying to find that one hidden edge or that perfectly undervalued stock. Well, the efficient market hypothesis, or EMH for short, answers that with a pretty strict academic rule. It essentially says, no way. You cannot consistently earn abnormal returns because all the relevant info is already baked right into the price. If a stock is trading at $100, the EMH argues that price is a perfect, flawless reflection of every piece of data currently available in the whole world. Basically, by the time you're reading a news headline, the market has already digested and adjusted the price. Moving right along to Section 2, 3 levels of market efficiency: weak, semi-strong, and strong. Let's step through how this actually breaks down. Step 1 is the weak form, which states that prices only reflect past data, things like historical prices and trading volume. Step 2 is the semi-strong form. This one includes all publicly available news, so we're talking earnings reports, balance sheets, that kind of stuff. And then step 3 is the strong form. This is the ultimate, extreme theoretical level, which claims prices reflect absolutely everything, including private insider secrets. Now, here's the massive catch for everyday traders trying to make a buck. Technical analysis, which relies on charting past prices, that's not going to work consistently under weak efficiency, because that historical data is already priced in. And fundamental analysis, which looks at public financial statements, that yields absolutely no consistent alpha in a semi-strong market, simply because everyone else is looking at the exact same public data you are. Let's get into Section 3, reality check: Apple and GameStop, theory versus real markets. Okay, let's bring this down to earth and see how it plays out for a massive company like Apple. In a semi-strong efficient market, when Apple drops a huge, better-than-expected earnings report, algorithms and institutional investors react almost instantly. The price adjusts in a matter of seconds. Literally, by the time a retail investor even hits buy, that opportunity for an abnormal profit is already long gone. That right there is semi-strong efficiency working perfectly in the real world. But man, contrast Apple's hyperlogical, algorithmic efficiency with the absolute wildness of the 2021 GameStop meme stock surge. During the whole GameStop event, the stock price completely detached from the company's actual financial fundamentals. It was driven entirely by human emotion, herd behavior, and Reddit threads. It spread like wildfire. This shows us super clearly that while markets are mostly efficient, like we saw with Apple, human psychology can totally break the machine temporarily and create massive, wild inefficiencies. And, if we look at illegal insider trading, someone buying shares right before a secret merger is announced totally earns a profit. That actually proves that strong form efficiency doesn't really hold up in the real world. I mean, if the market were truly strong form efficient, even having a CEO's private locked diary wouldn't help you make money, because the price would somehow magically already reflect it. But in reality, insiders absolutely do profit, which is, of course, exactly why insider trading is illegal in the first place. On to Section 4, calculating your abnormal return, the key formula. So how do the pros actually measure this stuff? Let's break down the abnormal return formula. It's super simple. It's just your actual return minus your expected return. The RA is your abnormal return. That's the holy grail, what people often call alpha. R sub I is what you actually made in your account, and E of R sub I is what you theoretically should have made, given the broader market conditions and the risk you took. But here is the absolute kicker. If markets are perfectly efficient, your abnormal return is practically going to be 0. Over the long run, your actual return is going to perfectly match your expected return. Zip. 0. There are literally no free lunches in a perfectly efficient market. Section 5. How AI changes everything. Microsoft Copilot and beyond. This whole dynamic creates a fascinating double-edged sword in our modern era. Tools like Microsoft Copilot are actually making markets more semi-strong efficient through instant data processing. I mean, they can read millions of tweets, analyze financial statements, and execute trades in literally milliseconds. But simultaneously, they're kind of causing huge inefficiencies by sparking algorithmic herd behavior and these crazy, sudden flash crashes. When thousands of AI bots react to the exact same news trigger at the exact same time, they can artificially pump or dump a stock way past its true value. All right, final section, Section 6. Test your market knowledge. CFA practice time. Let's see what you've learned. Question 1. If asset prices reflect all publicly available info, like those Apple earnings we talked about earlier, what form of efficiency is it? Take a quick second to lock in your answer. Are we talking weak, semi-strong, strong, or inefficient?
If you guessed semi-strong form, you are absolutely spot on. Remember, public data is the classic hallmark of that semi-strong tier. Okay, let's try a little quick math for question 2. Given a 12% actual return and a 10% expected return, what's your abnormal return? Think back to that super simple formula we just looked at. The abnormal return is exactly 2%. You just take your actual 12%, subtract your expected 10%, and there you go. Hey, if you're consistently pulling in a 2% abnormal return, you are definitely doing something incredibly right in a highly efficient market.
To wrap up this explainer, I want to leave you with this phenomenal final insight. Markets are not perfectly efficient, but they are efficient enough to make beating them consistently extremely difficult. So the real question is, are you ready to navigate a market that isn't perfectly flawless, but is just smart enough to challenge your every single move? Keep learning, keep analyzing, and hey, thanks so much for joining me today.